And South Africa's fund management sector is trying to stay abreast of all the developments, and one of the major moves includes the evaporation of cash bears. This is according to the Bank of America's Global Research Unit and its latest South African Fund Managers Survey. Joining us via phone for more is John Morris, South Africa Strategist at Merrill Lynch. John, welcome to the show. So, looking at some of the takeaways that I see from the latest survey, really what I'm seeing here is lights dim on commodities, equities and banks going up. So what would you say are the main reasons for fund managers moving away from commodities and equities and more towards cash?
Yes, well, thanks very much, and hello. I think, first of all, the global environment is deteriorating. So growth is slowing. We think there will be a recession in the US, the UK, and Japan. And commodity prices are coming under pressure from demand destruction with higher prices all around the world. So with that in mind, because South Africa's commodities are the lifeline for domestic assets, in this survey you see a high number of managers are commodity bears. I think that's coming from the global environment, and because of that, it's having a knock-on impact to their views on equities, domestic equities, banks, and other domestic sectors like retailers.
Now, one thing that I did note is your note with regards to a diminishing in terms of weight in terms of equities and moving more towards offshore investment. What's happening there? Perhaps you can give us more insights into why more managers are looking abroad.
I think with the changes in Regulation 28, where pension funds, provident funds, investment managers can now put or move or invest 45% abroad. So if you look at the allocation in this survey, the offshore allocation went up from 23% to 25%. So even the 25 is below the previous limits, which were 30, 35%. It depends on what kind of institution you are. So the fact that now managers can go up to 45%, there's more of an appetite to look abroad and be more diversified. But it's in this survey, managers are underweight, but they're less underweight offshore, and they also say they want to invest more offshore in the next 3 months. And if you go through the numbers, it could mean 300 billion of equity investments moving abroad, but it's going to take a long time because managers still think that equities are undervalued, not as undervalued as they were, but they're still undervalued, and they still think there's some attractive domestic stocks. Mm-hmm. So it'll take time.
Now, John, one of the risks that I do take note that have been mentioned in the survey, and also that we hear time and time again when fund managers are evaluating investments locally versus investments abroad, is the risk of load shedding. Eskom, you also cited civil unrest and recession, but honing in on Eskom and the risk of load shedding, stage 8 and the likes, with the president's latest announcement, do you see that this would perhaps have a change in terms of how fund managers are allocating their reserves?
Yes, I think all those risks, particularly civil unrest, that response has risen since the last survey, quite materially. And then a survey record, 83% did not see an operational solution to Eskom. So, that response may improve as we go through time, with some of the loosening up on regulation in that sector. But I think South Africa is still seen as a low growth country because of the lack of reforms, particularly on skills, and you have a rigid labor market. So until you saw reforms on those fronts, then I think managers would still like to diversify, because you can't have the majority of your assets in emerging markets, namely South Africa. And so it makes sense to diversify abroad. And just one other point I'd like to make is that you mentioned cash bears evaporating because the repo rate is going up quite aggressively. So your returns on equities does diminish in that kind of environment going forward. So I think there's always opportunities abroad, and managers clearly want to be positioned for that.
And in terms of bonds, what have been some of the findings there?
Yeah, it's an interesting one because the returns from bonds in this survey is 18%. Now, when the survey was conducted, bonds were at 11.5%. They've come in a bit. They're around 11.1%. So that return's gone down to 15%. So I think managers, whenever they see a sell-off in bonds, they do want to invest in bonds, and we've seen that in this survey, that managers want to use their cash for offshore, but also bonds, the bonds at the higher levels, because on balance, they feel that the yields should be closer to the 10% mark, not the 11% mark. So they want to buy bonds, and the responses from the survey point to positive returns over the next 12 months.
Now, in closing, I'd love to get your thoughts with regards to the statement that you made, more defensive, less conviction. What do you mean by that?
Yes, I think in the survey, again, because the view on commodities is negative, that means that it puts pressure on the rand, on bond yields, on equities, on domestics, because of the link between the valuations of domestic assets and the rand and bond yields. So when commodities are under pressure, then assets are under pressure. So that's why they're becoming more defensive and more active in this portfolio, in this survey. In previous surveys, they were pretty much had the same views, for quite some time. But in this survey, the views changed quite a bit, quite dramatically. That's why I say they were more active in the survey in terms of their responses. But they have become more defensive in terms of risk, and less conviction, because it looks like they're hugging the benchmark. So if you look at the sector weights, there's not big standouts. There are a few, like healthcare is a big overweight by manager. Personal goods, which is luxury, is a big underweight. But by and large, the sectors are quite close to neutral. And even banks, which is number one as their preferred sector. But in the positioning, the overweight has reduced a lot, closer towards a more neutral kind of stance.